Welcome to the House Lux Estate, your trusted guide on the journey towards financial freedom. Here, we shed light on the mysteries of wealth creation, demystifying the complexities of investment opportunities, and guiding you on the path to prosperous living. Our channel is dedicated to providing valuable insights, practical tips, and inspiring success stories in the realm of finance and investment. Today's topic? We're diving headfirst into the exhilarating yet daunting sphere of high-risk, high-reward startups. These ventures, often characterized by their innovative ideas and disruptive potential, carry a significant risk of failure. However, they also promise extraordinary returns if they succeed, making them an enticing prospect for the daring investor. Remember, with great risk comes the potential for great reward. It's about understanding these risks, managing them effectively, and positioning yourself to reap the benefits should the startup take flight. So buckle up, fellow wealth seekers. Today, we delve into the thrilling world of high-risk, high-reward startups. High-risk, high-reward startups are exactly what they sound like. They're ventures teetering on the brink of uncertainty, yet brimming with the potential for unprecedented success. Picture a tightrope walker, balancing precariously, yet moving forward with determination. That's the essence of these startups. They're not for the faint-hearted, but for the brave and the bold who see beyond the risk, to the reward that could potentially be game-changing. So what makes these startups high-risk and high-reward? Well, they're usually based on groundbreaking ideas or innovative technologies that haven't been proven in the market yet. They're venturing into uncharted territories, attempting to disrupt existing markets or create entirely new ones. The risk lies in the uncertainty of whether these new ideas will catch on, whether they can outperform established competitors, whether they can attract enough customers, and ultimately, whether they can become profitable. But where there's risk, there's also reward. If these startups do succeed, they can yield returns that far exceed those of traditional investments. For instance, think of the early investors in companies like Amazon or Tesla, who took a chance on unconventional ideas and are now reaping the benefits. Investors might be interested in high-risk, high-reward startups for several reasons. First, they offer the opportunity for significant financial gain. Second, they provide a chance to be part of something innovative, something that could potentially change the world. And third, they present an exciting challenge, a chance to test one's acumen in predicting which ideas will succeed and which will fail. But it's important to remember that investing in these startups is not a guaranteed path to riches. It's a gamble. And like all gambles, it can lead to losses. That's why it's essential to balance these investments with more stable and predictable ones, to create a diversified portfolio that can weather the ups and downs of the market. Now that we understand what high-risk, high-reward startups are, we can explore how to invest in them. Investing in high-risk, high-reward startups requires careful consideration and planning. It's a bit like venturing into a dense forest. You wouldn't just saunter in without a map, would you? Similarly, when it comes to investing in startups, having a solid plan and understanding is pivotal. The first essential step in your investment journey is thorough research. Start by identifying the industries or sectors that resonate with you. Look for startups that are breaking new ground, offering innovative solutions, or disrupting traditional business models. Keep in mind that high risk also means potential for high reward. The next Google or Amazon could be lurking in this pool of ambitious startups. Next comes the due diligence phase. This involves a deeper dive into the potential startup's business model, team, financials, and market potential. Understand their revenue model and how they plan to scale their business. Scrutinize their financial projections and their assumptions. Are they realistic or too optimistic? Analyze the team's experience and track record. Do they have what it takes to steer the startup to success? Understanding the market is another crucial aspect. Look at the size of the market and the startup's potential share. Is the market growing, stagnant, or declining? What are the key trends shaping this market? Who are the competitors and what is the startup's unique selling proposition? These are some of the questions that need to be answered to gauge the potential success of the startup. Another vital factor is risk management. High-risk investments should only form a part of your overall investment portfolio. The golden rule of investing is to never put all your eggs in one basket. A diversified portfolio can help absorb shocks from any unsuccessful ventures. Lastly, patience is key. Startups take time to grow and become profitable. Don't expect quick returns. Be prepared for the long haul. With these basics in mind, we can now delve deeper into the process. Investing in high-risk, high-reward startups involves several key steps. Now let's delve into the exciting world of startup investing. Step 1. Identifying potential startups. This is a crucial step. You need to be on the lookout for startups with innovative ideas, strong teams, and potentially disruptive technologies. This could be a tech startup developing a groundbreaking app or a biotech company working on a revolutionary medical treatment. You can use platforms like AngelList and Crunchbase, where you can find information about various startups, their industries, and their funding status. Step 2. Evaluating their potential. Once you've identified a promising startup, it's time to do some digging. Look at the startup's business model and growth strategy. Is it scalable? Are there any significant barriers to entry? You also need to evaluate the team. Is it diverse and experienced enough to navigate the challenges that lie ahead? Don't forget to look at the startup's financials. While it's common for startups to be unprofitable in their early stages, you should see a clear path to profitability. Step 3. Making an investment. If the startup passes your evaluation, it's time to invest. But how much should you invest? A good rule of thumb is the 10% rule. This rule suggests that you should invest no more than 10% of your investable assets in high-risk investments. When investing in a startup, you typically receive equity or shares in the company. Be aware that investing in startups is not like investing in publicly traded stocks. It's illiquid, meaning you can't easily sell your shares if you need cash. Step 4. Managing the investment. After you've invested, your work isn't over. You need to keep a close eye on your investment. Monitor the startup's progress, attend shareholder meetings, and stay informed about industry trends. If the startup is doing well, consider reinvesting your profits. If it's struggling, you might need to cut your losses. Now, I want to leave you with one final thought. Investing in high-risk, high-reward startups isn't for everyone. It requires a high tolerance for risk, a lot of patience, and a willingness to lose your entire investment. But if you do your homework, have a solid investment strategy, and keep your emotions in check, it can be a rewarding way to diversify your portfolio and potentially achieve substantial returns. Remember, all investments carry risk, and past performance is no guarantee of future results. Always do your due diligence and consult with a financial advisor before making any investment decisions. By following these steps, you can greatly increase your chances of success. Investing in high-risk, high-reward startups can be a thrilling and potentially lucrative venture. It's an adventure that takes you through the vibrant landscape of innovation, technology, and entrepreneurial spirit. Today, we've journeyed through this landscape together, understanding its highs and lows, its risks and rewards. Let's take a moment to revisit the key points we've covered. Firstly, we delved into the essence of high-risk, high-reward startups. These are often young companies, powered by groundbreaking ideas and fueled by the potential for exponential growth. However, they also come with significant risks, which is why it's crucial to understand their unique dynamics before diving in. Next, we tackled the basics of investing in these startups. We learned about the importance of thorough research, the value of diversification, and the need for a clear investment strategy. These principles form the bedrock of successful investing in this high-risk environment. Then, we proceeded to our step-by-step guide, where we broke down the investment process into manageable parts. From identifying promising startups and conducting due diligence to negotiating terms and monitoring your investment, each step is a critical piece in the puzzle of successful startup investing. But remember, the journey doesn't end here. The world of high-risk, high-reward startups is ever-evolving, and staying ahead requires continuous learning and adaptation. Keep exploring, keep questioning, and most importantly, keep investing. But also bear in mind that while the potential for high returns is tempting, it's essential to invest only what you can afford to lose. High-risk investing is not for everyone, and it's crucial to assess your risk tolerance before embarking on this journey. Thank you for joining us on House Lux Estate. Today's journey was enlightening, but there's so much more to explore. If you found this video helpful, don't forget to subscribe for more insightful content. Until next time, happy investing!